Okay, it's after 1 o'clock, so we need to get started. First thing I want to mention is that apparently the quiz worked successfully because at least one student took it and got an A on it. So last time I checked, only one person had done so far. At any rate, I've also started looking at the homework assignments, and some of you are missing quite a few of them. So you need to get to work on the homework that's assigned. Then what I was planning to do today was to start the PowerPoint for Chapter 8. We finished Chapter 7 Wednesday. I'll be getting the quiz uploaded to Canvas for that chapter as soon as I can, but I'm falling farther and farther behind. All this online stuff is really a lot of work for me. So when I can, I will. At any rate, I think it's worked now so that this is going to be recorded. And let's take a look now at Chapter 8 PowerPoint. Didn't work. Got to reopen it. Okay, now hopefully everybody sees the introductory slide for Chapter 8 on government-wide statements, capital assets, long-term debt. So what the main objective of this chapter is to understand how all of these different funds get put together to prepare a government-wide financial statement. So that would be preparing worksheet entries to convert it from accrual basis, or to accrual basis, I should say. And then the internal service fund has to be combined with the governmental activities and then required schedules. And then because the governmental funds don't include fixed assets or long-term debt, then they have to add those in. And so there's schedules that keep the information. So for those of you who have had advanced accounting, this is similar to the worksheets used to combine a parent company with its subsidiaries. Entity-wide statements are prepared at year end, and by entity-wide, they mean a statement that covers everything within that entity. So all the different funds put together. So government type funds are converted from modified accrual to accrual basis. They add in the long-term assets, which are depreciated. They add in the long-term liabilities. then the internal service fund is added in with all of its accounts, and then they're consolidated together, except for fiduciary funds. And as we saw last time, you don't include those because the government doesn't actually own the money that's in them. So we looked at this diagram in the previous chapter. The governmental funds are changed from modified accrual into accrual basis. Then we have fiduciary activities that are not included. Then the proprietary activities, which are the business-like ones. If it's an internal service fund that provides services to the government, its activities are combined and all of these are put together. But enterprise, since it's externally oriented, is kept separately. Now, these are already on accrual basis, so they don't need to be modified or adapted or changed. And so here it's talking about changing to accrual basis. Internal service funds added to governmental. And here's how you could do it on a worksheet. So they take the governmental funds that are added together, cash investments, and then what's missing from the assets of the governmental fund are the fixed assets. So here they're adding them in. And they would have to deduct accumulated depreciation from it. Then they add in the internal service fund. To get the total. This isn't complete because this is just the debits. And if I were setting this up, I wouldn't do it on a bookkeeper's basis with debits and credits. I would do assets, then liabilities balance sheet first, then the expenditures and revenues. But as long as it's all there, it doesn't matter. So essentially what they're doing here in this section is converting to accrual basis, adding in the internal service fund, and then add it together to get the total for the government. And once they've done that, they've now added in the long-term assets and liabilities. Then down here it says expenditures for capital assets and principal payments are eliminated. Turn on your audio and let's have a discussion about why you think they did. If you have a dog, mute your audio. Let's suppose the capital asset was a building, no, not a building, let's say major computer purchased by the government. If a business purchased a major computer that they're going to use for their whole system for the company, what would be the journal entry that they made when they purchased it? That they paid cash. What would they debit?
Would it be encumbrances?
No, I said, what would a business enter?
Will it be
If they're paying
equipment?
cash,
If they paid cash, cash would be the credit. What would be the debit if they purchased a major expensive computer?
Is it equipment?
Okay, they would debit equipment or computer. But what did the general fund record when they purchased it? They recorded it as an expenditure. And if it's going to be on accrual basis, then that expenditure has to be removed because now they'd be double counting it. They're counting it as a capital asset, so they can't count it as an expenditure and an asset at the same time. Plus, they're also recording depreciation for it wearing out. So this has to be done as part of the conversion from modified accrual to accrual basis. Okay, interfund balances are eliminated. That would be something that if you had advanced accounting, it's exactly the same as an intercompany transaction, which you had to learn on the spreadsheet how to eliminate those and why. So due from other funds, if the internal service fund was owed money from another fund that was in the government, well, it's still all within the same government. So if you had a receivable and a payable from one part of the government to the other, you have to eliminate them. Otherwise, you're really overcounting what's happening to the government as a whole. That's what's going on here. Inter-fund transactions may need to be eliminated. Capital assets. Here's how you would add those into the overall statement. You'd have a worksheet where you would record the amounts you had at the beginning of the year, net of accumulated depreciation. You have that information from last year. The balance in capital expenditures is eliminated. Let's go back. Capital expenditures is down here, and that means that it's treated sort of like an expense for the general fund, but it's an expense that was for purchasing a capital asset. So they eliminate that so that they can capitalize the asset instead of recording it as an expenditure. So new assets, they have to eliminate the modified accrual account capital expenditures and then capitalize the asset. Then they record depreciation for the current period. Balance and proceeds from sale of capital assets is eliminated. The asset and accumulated depreciation is removed and the resulting gain or loss is recorded. So this is how, when they sold a capital asset, it was recorded under modified accrual, and it completely ignored whether or not there was a gain or loss on the sale. So they get rid of that account and record it the way a business would record it. Since the focus of governmental funds is the budget and spending, they do not include fixed assets or the depreciation or long-term liabilities. So these have to be added in to get accrual basis government-wide financial statements. Questions or comments before we move on? So those 4 steps are shown here as journal entries. They debit capital assets, the amount that was at the beginning of the year, credit the net position, debit the capital assets that are new in the second entry, get rid of their capital expenditures account. Now they've got all these capital assets, they depreciate them, and they don't use accumulated depreciation. They directly deduct it from the capital assets. Then if they sold any, they get rid of the account proceeds from sale of capital assets. They credit the capital asset, and then they'd credit a gain, or they could debit a loss if it was a loss. Beginning of the year, long-term, okay, here's the next thing we have to convert. Because governmental funds do not include long-term liabilities, but their CAFR, the comprehensive report, must include them. So they take the beginning of the year long-term liabilities in the worksheet. Then bond proceeds meant they issued new bonds. In governmental funds, they count that more like a kind of revenue because it says how money came in, and they didn't record a liability. So they get rid of the bond proceeds account and record a bond liability account. Then if they paid back any bonds, any or other long-term debt, they eliminate the account that says expenditure bond principal and then reduce the liability balance. And then they amortize premium or discount on bonds. So the entries for those four things would look like this. Debit net position, credit bonds payable to add back in the bonds. Then if they issued bonds, the proceeds that were in the governmental accounts are debited to get rid of them. And they credit bonds payable and bond premium, or it could be a debit to a bond discount. Then if they principal spelled correctly here, wrong here. If they paid back bonds in the governmental accounts, they recorded it as an expenditure and not as a reduction of the liability. So that's what they're doing in this entry. And then if there's a bond premium to amortize it, then they're debiting bond premium and crediting interest expense. Other conversion adjustments. Deferred inflows of resources, property taxes. Remember, previously we looked at the 60-day rule, which said that if property taxes were going to be collected more than 60 days after the budget period ended, they're not counted as a receivable, but as a deferred account. But for GAAP purposes, it should be a receivable. So they have to make an adjusting entry for that. Expenses not recorded in government funds in their model may need to be accrued. The example they're giving is that the governmental funds didn't record the cost of compensated absences, so they would record that. They have to record accrued interest expense and other accruals, and then eliminate interfund transfers. So here they have that deferred inflow. It was a credit account. They eliminate it and record property tax revenue. Then property tax revenue is debited, net position at the beginning of the year is credited to reverse the previous year. So this year, end of the year, this is reversing the entry that was in existence from the beginning of the year. Record the liability for compensated absences. Bottom entry is how it was recorded by business when they record this year's compensated absences. At the beginning of the year, they had to reverse the entry from last year. Then accrued interest is recognized. They have to undo its recognition at the beginning of the year. Transfers in, transfers out are eliminated. Okay, so we mentioned already that the internal service funds are added into the governmental activities. And here it's saying that if they have an internal service fund, but enterprise fund is predominant in it, then they're going to separate out the business activities. And I'm not sure how practical or frequent that's going to be. Add internal service funds, assets and liabilities. Add the income of the internal service fund. Then government expenditures were recognized as revenue by the internal service fund and as an expenditure by the governmental funds. So that's counting the same thing twice. So they have to eliminate that in all those activities between the internal service fund and the governmental activities. So here they give journal entry examples, but the ones that they have in the textbook are better because they've got numbers and you see where the numbers are coming from. So let's move on. Government-wide, there's a statement of net position and a statement of activity, no cash flow statement. Net position is the equivalent of a balance sheet. Government and business types are put in separate columns. So government includes the internal service funds. If they have how is this getting written on? Are you seeing the scribble?
I see it.
I didn't put it there. It spontaneously appeared. Is there a ghost in my computer?
No, I'm sorry. It was me. I was making a note, and I didn't know it was going to be on your screen as well.
Oh, okay.
I'm sorry.
I didn't even know you were here. Okay. All right.
I'm trying to see how can I get rid of it.
Don't know. Doesn't matter that much. There it goes anyway.
Oh yeah, I'm getting rid of it.
Okay, it's gone. Government activities includes government funds, internal service funds, not fiduciary. Statement of activities. If they use the net cost approach, they start with functional expenses and subtract from them the program revenues, which shows net cost. From the net cost, add general revenues, special items, and transfers to show the overall change. Change plus beginning net position equals the ending balance. And that would agree with the amount on the statement of net position. So how do we get from governmental funds to the government-wide net position? We start with the government fund balances, summarize all the changes that we had to make, typically add in long-term assets, add in internal service funds, change deferred revenue to revenue, and here's something that I really thought was stupid about the way that they do this. Deferred revenue, so it's revenue that they're not counting as revenue because it's going to come in too late. So why are they classifying that as a liability when they don't owe anything to anyone? That's just goofy in my opinion. At any rate, then they add in the long-term liabilities. So activity statement reconciliation reconciles changes in fund balances to changes in net position for the government activities. So it explains why the accrual basis ones are different from the modified accrual. So for example, depreciation is compared to capital outlay expenditures, gain or loss in sale of assets versus proceeds. Bond premium amortization is not included in modified accrual, and so on. So what they mean here, no specific method of keeping track of long-term assets is required by GASB. GASB says that when you have a general fund, it doesn't include the long-term assets. But when you prepare the CAFR, they have to add it back in. Well, they don't tell you where to keep the information that enables you to do that. So each government organization is going to have some kind of accounting system with records that's going to keep up on the cost, location, and life of all of their fixed assets. If they don't do that, then they can't get the information they need for the government-wide statements. And it used to be that this was done with something called the General Fixed Asset Account Group, but it was just a list of balances of capital assets. So what are the capital assets? Plant, infrastructure, and equipment. So infrastructure is the thing that businesses would not have. That would include things like streets and water lines, sewer lines, whatever. Record as asset, depreciate them. Land, just like a business, record as asset, do not depreciate. Collections. That would be something like a museum collection. If it's held for the public to look at or use for education or research, and it's protected, and if they sell any of it, the money has to be put into another collection, then this is not considered to be the same as their other kinds of capital assets. So if a city owned a museum, the museum contents would be classified as collections. If a library had books, And for education, they would be classified as collections. Infrastructure, roads, bridges, drainage systems, sewer systems, dams, lighting. Capitalization used to be optional, now it's required. Once capitalized, governments may depreciate the infrastructure assets and use what's called the modified approach, which does not require depreciation if assets are adequately maintained. So could the modified approach be used in Jackson? Hello, is anybody there?
I'm sorry, what was the question?
Could the modified approach be used in the city of Jackson?
No.
Why not? It says
I
it's
mean,
an option.
oh, wait, which is not required. Oh, then
Here's the
yes, I guess.
problem. Jackson's infrastructure is not adequately maintained. So they would have to depreciate their infrastructure. The city
lot.
engineer of Jackson was interviewed on the television news some months ago, and he said that if they got everything in the infrastructure fixed that needs fixing, it would cost $1 billion. Modified approach to infrastructure. So if it's adequately maintained and they're not going to depreciate, then they have to maintain an inventory of their infrastructure, do condition assessments every 3 years, estimate the annual cost to maintain at target level, and document the target maintenance level is being met. So in this modified approach, these maintenance expenses would be recorded as expense rather than depreciation. Long-term debt. Common types of government long-term debt: general obligation bonds, long-term leases, compensated absences, claims and judgments. If they've been sued and owe money for something, that's a claim of judgment. Whoops, and landfill closure liabilities. If the government owns a garbage dump, then when it's filled, they have to spend a lot of money restoring the land, covering up all the garbage with soil, planting trees and grass and that kind of stuff. So that's a long-term liability. Record keeping. They've got to keep record of their long-term liabilities somewhere. It used to be that this is done with what was called the general long-term debt account group. But an account group is just a list of long-term liabilities with the amounts of their balances. Additional reporting, schedule of changes in long-term debt. That compares how much new debt that they're incurring and how much they've been paying off in a table over time. Schedule of debt service requirements to maturity. That shows each year for many years up into the future how much of their long-term debt is going to be maturing. Computation of legal debt margin. Debt margin is the percentage of debt that they're allowed to have compared to their assets. So this margin shows whether or not they can legally borrow more money or not, or if they're at the limit. So I would have called this a debt limit analysis to find out whether they would be able to. Direct and overlapping debt. Takes all of the debt and puts it in one dashboard so people can see all of it. Okay, and that ended the PowerPoint. So, questions, comments, anybody?
Or quizzes on Wednesday, correct?
Well, it's sort of take it when you're ready.
All right.
So at least one person already took it. And I've got the score and recorded it. I can't remember when I checked on that. I think it was this morning.
I thought the quiz was due today.
Well, whatever it says in Canvas is the due date. What really matters is that you get it done before it's removed from Canvas. So if it was due today and you wait until Monday, that's not going to be a problem. But if you wait 2 weeks, it might not be up there anymore.
Because it says it's due tonight by 11:59. We're
Right.
available until
You see where it says available until what?
April 24th.
Okay. And that was really a little bit too generous, because if you wait until then to start taking your quizzes, you're not going to have time to study for them before I turn in the final grades.
So you put like a due date, pretty much that you would like us to do it by.
Right.
But it's available.
Because I didn't see any reason why you couldn't take that quiz this week, because it's stuff we covered before spring break.
I see. Okay.
And so there's no reason to wait. But given the extraordinary circumstances of what's going on with the pandemic, we're just not really being that worried about people getting stuff on time.
Gotcha. So the due date's merely a suggestion, but
It's a strong suggestion.
yeah,
And it's, in addition to being a strong suggestion, I'm saying that if you haven't started working on it now, you're going to have trouble later in the course, because you're going to get behind.
Okay.
Okay, so we are missing Varsia. Who else? I think that might be it. All right, so our 40 minutes is about up. So on Monday, we will start in on the Chapter 9 PowerPoints. So I'll see you all then.
Yes, sir.
Talk to you later. Bye.
See you.